Welcome to our weekly video series. If you look at economic data and the performance of the stock market side by side, you'd be forgiven for thinking that something was out of whack. Last week, we received confirmation that 227,000 jobs were lost in the Australian economy in May, even as lockdown measures were being gradually relaxed. 2 weeks ago, we learnt that GDP contracted in the March quarter, setting the stage for the first Australian recession in 29 years. Despite this raft of bad economic news, investors have decided to buy equities. Our local stock market index, the ASX 200, rose by 1.6% last week. It has risen for 11 of the past 13 weeks. And it's a similar story for the currency. The Australian dollar hit a low of 57 US cents on the 19th of March and hit a near 11-month high of more than 70 US cents on the 11th of June, before correcting modestly lower. Part of the reason for this disconnect is that the economic fallout has not been as bad as initially feared. Our remarkable success in containing the virus has led to restrictions being lifted sooner than first anticipated, allowing economic activity to resume, although Victoria has had to return to tighter restrictions over the weekend. Preliminary data for retail sales shows that spending bounced back in May as shops reopened. Turnover rose by a record 16.3% in May, following a record fall of 17.7% in April. Financial markets are forward-looking and are attempting to price economic developments before the hard data is available. They are therefore prone to overreacting. But there are other factors at play as well. Central banks and governments around the world have responded to this unprecedented economic shock with an unprecedented injection of stimulus. As stay-at-home orders were grinding economic activity to a halt, governments and central banks unleashed the most powerful tools in their arsenal to ensure financial markets remained liquid and to provide as much support as possible to aid a recovery. In recent weeks, central banks in particular have reiterated their commitment to maintaining support. Accommodative policies from central banks have far-reaching consequences, one of which is the search for yield. Investors are choosing riskier assets as more clarity emerges around the shape of a potential economic recovery, and as easy monetary policy brings down yields on assets such as government bonds. However, there is still a long, challenging road ahead. The risk is that the economic impact of this virus has a longer tail than investors are pricing. Markets will remain volatile and vulnerable to downside surprises, including a second wave of infections and an escalation of geopolitical tensions. Thank you.